Hello and welcome to our special coverage ahead of Nigeria's July Monetary Policy Committee decision. I'm Kenneth Igbomo. As central bankers gather in Abuja, they do so against the backdrop of cautious optimism in global markets, but also persistent uncertainty. Across the world, monetary policy is at an inflection point. In the United States, the Federal Reserve is signaling patience, even as inflation gradually edges towards its 2% target. Market once anticipated up to 3 rate cuts in 2024 are now recalibrating. In Europe, the European Central Bank lowered the 3 key ECB interest rates by 25 basis points, and its next decision is set for the 24th of July. Meanwhile, inflation in England hit an 18-month high in June, as the Bank of England is scheduled to meet on the 7th of August to decide on the way forward. So globally, the consensus is shifting from aggressive tightening to a more nuanced, data-driven wait-and-see stance. Here in Africa, we're also seeing monetary authorities weigh growth risk against inflationary pressures. In South Africa, we await the decision of the South African Reserve Bank as they meet tomorrow. In Ghana, they had an emergency meeting last week and noted that there is significant improvement in the country's current macroeconomic conditions. With a positive outlook, the committee noted that inflation expectations are now broadly anchored, external buffers have now strengthened, and the confidence is returning to the markets in Ghana. The MPC will meet on the 28th of July next week, and over in West Africa, the Central Bank of West African States, which covers the Wemu region, kept its policy rate at 3.5%, prioritizing currency stability for the CFA zone amid global volatility. So what does this all mean for Nigeria? Joining me live in studio, I have Bismarck Rewane, the CEO of Financial Derivates company. We also have Toyin Sanni, the CEO of Emerging Africa Group, and also Gregory Kronsten, the consultant on African economies, also joins us virtually. Thank you so much for your time today. Let me start with Bismarck in studio and just get a quick macro sweep. The conditions leading to this MPC meeting. We've seen improvement in inflation. We've also seen the long-awaited GDP figures coming. What's the biggest signal right now from the macro space?
I think that one can look at it from a transient and temporary point of view, and one can look at it from a structural point of view. One of the big risks is that you move too quickly ahead of the global interconnectedness that we see. So, yes, it is true that the GDP numbers have come out. It is true that the approximately $250 billion in GDP, Nigeria is the 4th largest economy in Africa and the 40th largest economy in the world. But for you to achieve the $1 trillion economy by 2030, you need to grow by 15 to 17% per annum for the next 5 years. That's not going to happen when we are seeing growth of 3.1%. Therefore, something has to give. Something has to give. So if you have to have an investment-led strategy, you've got to actually begin to deal with what signals are you sending and how are you going to anchor expectations with this interest rate move today. So ordinarily, before the GDP numbers came out, my view was that we would see a 25 basis point cut, about 70% probability and 30% holding. Now with these GDP numbers out, I think it's almost equal. In other words, I think that we might see a 40% probability that they'll be cut by 25 basis points. And there's a 60% probability that they hold to wait for other steps being taken by the Federal Reserve, by the Bank of England and others, because we're not living in isolation. So that is what I believe is likely to happen. But all said, there's a lot of political pressure to ensure that the growth and the GDP numbers and the data that's coming out can translate and can actually trickle down to the rest of the economy. So if I'm going to be going by the political weight, I would say almost certainly that there'll be a cut. If I'm going by the independent and autonomous attention and what should be done prudently, I would say they'll hold until September. But how long are you going to be holding? That's the point.
All right, so you're leaning more strongly on the hold. Let me get other comments here. Let me bring in Toyin Sanni here. Inflation is easing. We're seeing food prices moderating. External reserves have risen. Is that enough for a rate cut, in your opinion? Toyin?
So if you were to ask me what I would want, I would say rate cut, because we do need to take decisions that will stimulate the long-term growth of our economy. And the rate hikes, whilst they have been good in terms of managing inflation, from a monetary policy perspective, they have been good, but they have also had an effect or an impact on the larger economy in terms of the opportunities to grow and for businesses to access funding at rates that are more pro-development and more affordable. But I think that the MPC will probably hold one last time and then be looking at Q4 when they can begin to gradually ease. And so I think this hawkish perspective or approach will hold a little further. But I think it's good news that inflation has moderated. I think it's good news that we're seeing more stability also in terms of the foreign exchange. But I think they're going to push for a little more. Inflation is still above 20%. So, I mean, it may be good, but it's still high.
Maybe good, but still high. But Gregory, let me bring you in here. And I'd love to get your opinion on what the true cost of maintaining an MPR at 25% is. First on credit, growth, and even investment into Nigeria.
Yeah, well, I think just, I'm expecting a small cut. But to answer your specific question, what's the impact? Well, on growth, it has to be slowing growth down. On investment, well, it depends what sector you're talking about. And on credit, similar to growth. But look, I mean, the rates are too high, but they've been high for good reason. There is some light now to sort of look at the end of the famous proverbial tunnel. And, if you look at, I think if you go back to the last MPC meeting, the verdict was, oh, well, we need to better understand the near-term developments. Well, the near-term developments since then have been broadly stable. The FX rate reserves have picked up. There's evidence of FPI investment in the bond market. The bond rates are nicely tumbling. We have, as you'd expect, we have an inverted curve. Oil production's picked up. So there are quite a lot of things to watch out for on the positive side. I just mentioned two other things on this point. One is inflation. Inflation's good, but I mean, it's headline inflation that's slowed. So, they have to move cautiously here. And the other one is the famous external perspective. I mean, 2 months ago, everyone was talking about Mr. President Trump, what he's going to do. And now he's going to think before sending these letters out, apparently, to the various presidents and finance ministers. But, from Nigeria's perspective, I mean, if you look at that famous blackboard he showed at the White House lawn, whenever it was, his big obsession was, no country should have a trade surplus with the US. Well, Nigeria does.
All right, seem to have lost that connection to Gregory there, but he's of the opinion that we could see a small cut in there. But I'm trying to imagine the scenarios here and the likelihood for market reactions here if in the likelihood that we see a rate cut. Some analysts believe that it could spark some bullish sentiment in the fixed income market and drive demand and also compress yields. I would like to know if you share the same opinion.
No, I think that the perception or the forecast that I see in the capital markets, it's about earnings. If you take into consideration the fact that corporate earnings in 2023 and 2024 were negative as a result of forex losses, and most of those international obligations have now been domesticated. So we are now almost clear and certain that the companies are going to be reporting profits, right, on a quarterly basis. They've not clawed back all the losses, but definitely you can see Nestle at 1,580, and you see MTN at 400. So it is expectation that because the cross-border risks that were affecting this corporate performance is now falling off, right? And that the banks who had reported forex gains have also shored up their capital. So that will be the reaction. But you must note something, that the Naira has appreciated against a falling dollar. Net, the Naira has only appreciated about 1% or so against the dollar. As against the pound, it has dropped, right? So technically speaking, we think that the reaction, if they hold, the market's not going to change. If they cut, the market is going to get probably irrationally exuberant, but that's the stock market. But generally speaking, for the first time in over 15 years, we see that the parallel market has appreciated more than the official market. As a matter of fact, people are now buying dollars in the parallel market and selling to the central bank.
All right, let me bring Toyin as well into this conversation. I'd love to get your take on what was said so far, especially the impact on the market. But some analysts believe that a rate cut could more or less dampen FPI FPI flows into Nigeria as the naira-denominated assets become less attractive. Do you share the same opinion, or do you think it could be slightly different?
Well, the immediate reaction, obviously, and since you talk about FPI, these are investments that are driven by near-time profits and revenues and returns. So definitely, if there's a rate cut and there are other more attractive alternative investment outlets, yes, it could impact. But I still think that a rate cut in the medium to long term is better even over time for also foreign portfolio investments, especially where it signals more stability in the larger economy and if it's backed up by perception of value.
Gregory, your take?
Yeah, well, I'm not so sure. I mean, there's quite a lot, if you're riding the curve, there's quite a long way to go, isn't there? So, you know, I'm not quite sure. I wouldn't say a small cut is going to spook the foreign investor. I'd have thought, you know, that they'll remain engaged because, you know, I mean, just see what's happened in the last week on the yields in the bond market.